The general idea behind the capital asset pricing model and the formula that captures this is that investors have to be compensated in two ways. Firstly, we have to take into account the time value of money. And secondly, investors have to be compensated for the risks that they are taking on a particular investment. Now, the time value of money is captured in the formula by what we call the risk-free rate. The risk-free rate is really the yield or the effective interest rate on a long-term government bond. That is referred to as the risk-free rate. We'll go into that in detail when we unpack the formula. Now, the riskiness of a specific investment is captured in the formula in the capital asset pricing model by way of a beta, what we call a beta. What the beta does is it simply captures and expresses the systematic risk in an investment such as a share relative to the market as a whole, relative to the stock exchange as a whole. We can also use the capital asset pricing model for the objective computation of a company's cost of equity capital. Now, the capital asset pricing model is mainly used for listed shares, which are liquid and where you can compare your specific share to the overall market. But it can also be used for unlisted shares if one assumes that the risks relating to these are the same as the listed ones. In the real world, there are usually adjustments performed on the beta if the capital asset pricing model is used for unlisted shares. And smaller companies are said to have a much higher risk. So we put through the adjustment on the beta to capture a higher risk, a big part of it being that they are smaller and they are not as liquid. It's much more difficult to get into them or to dispose of them. Fundamentally, all we are going to use the capital asset pricing model for in this module is to determine the cost of equity. So we're going to use the capital asset pricing model to help us calculate a cost of equity.